In India, every time $1 worth of stock is bought and sold, there's over $400 worth of derivatives contracts being traded. That is not normal. India has quickly become the epicenter for speculating on short-term stock price movements. And while the many amateur traders are losing about half a year's salary from placing these bets, there's a huge Wall Street firm that's found a way to make billions there.
You have been all over the Jane Street story.
Jane Street.
Jane Street.
Jane Street.
Jane Street. Jane Street.
Jane Street.
Jane Street Capital found what was effectively an infinite money glitch that's been so lucrative they surpassed Morgan Stanley and Bank of America in trading revenues last year.
It calls unlawful gains from the US trading firm.
Let me unravel the mystery behind Jane Street's trading strategy, how they leaked their secrets in a pointless lawsuit, and why regulators deemed the whole scheme to be nothing more than good old-fashioned market manipulation. The strategy that's printed billions in profits was born out of the insane trading mania that's taken hold of India's financial markets. Options trading has exploded. About $4 trillion worth of equity derivatives are traded every day on India's national stock exchange, meaning India's relatively small stock market is responsible for roughly 80% of the world's options bets. This report from FIA really helps to drive home how violent this boom is. In 2022, globally there were 54.6 billion options contracts that swapped hands. In 2023, that number doubled, 53 billion more contracts than the previous year, and of that, 51 billion came from India alone. Options contracts and other derivatives are a way to bet on how a stock's price will move in the short term, without actually having to own the stock. In the US, their huge derivatives market is 9 times bigger than the actual market for trading shares. In India, it's 422 times larger.
How much bigger is the market for insuring mortgage bonds than actual mortgages?
About 20 times.
Jokes aside, India's ballooning derivatives market is a completely different situation than the mortgage crisis in 2008, but that doesn't mean it comes without problems. India's securities regulator, SEBI, did a study that found 9 out of 10 individual traders in equity futures and options lost money in 2022, and they're not losing pocket change. The average losing trader lost about 110,000 rupees that year, which for context is about half the annual salary of a typical Indian worker. Imagine making $60,000 in America and losing $30,000 of it trading options. That's the average experience of a derivatives trader in India. Part of the explosion in market speculation is credited to the country's stock market boom, which has been on an 8-year bull run. Confidence and greed have surged, and those looking for even bigger returns are turning to the high risk, high reward of options trading. For the government, exchanges, and brokers, this has meant raking in more fees and commissions, all while traders, including a flood of men in their 20s and 30s, are almost all losing. The derivatives market is a zero-sum game. If someone is losing money, then someone is making money on the winning side of the trade. So if 90% of individual investors are losing, it begs the question, which traders are taking it all?
This is a firm that has been in the background. They're making billions of dollars, but now the way that they're doing that has been thrust into the open.
Jane Street Capital is a Wall Street firm that until recently was flying well under the radar. In fact, I wouldn't even be surprised if you hadn't heard of them. Founded in 1999, Jane Street is relatively young by financial institution standards. They're a proprietary trading firm, meaning they trade stocks, bonds, options, and other securities with their own money. So unlike a hedge fund which is investing money on behalf of clients, Jane Street to place trades. The benefit being that they're not constrained by some of the banking regulations that exist to protect clients. They can be more aggressive and very secretive about the strategies that they're using to profit. And boy have they hit it big recently. Their 2024 financial results were jaw-dropping. Net trading revenue doubled to about $20.5 billion. This year, in the first quarter, they were expected to do $7.2 billion, which puts them in the same league as some of Wall Street's biggest firms. They surpassed Morgan Stanley and sit only marginally behind Goldman Sachs and JP Morgan's trading divisions. Even more impressive, they have a profit margin of about 64%, with an estimated profit of $4.6 billion for Q1. How on earth are they making so much money? Jane Street is known as a market maker, essentially a liquidity provider. They are actively buying and selling securities to ensure there's always a price and counterparty available in the market. When someone buys a stock, they take the other side of the trade and earn a tiny profit on the transaction. Last year, Jane Street was behind more than 10% of all trading volume in the US, including $700 billion worth of ETFs every single month. They of course also use a variety of strategies to profit from short-term price movements, but no one really knows how they're so successful. They've been labeled the secretive US firm that no one's heard of, and they almost never talk to the media. Fun fact, you might have actually heard about Jane Street a few years ago when crypto fraud Sam Bankman-Fried was jailed for siphoning customer deposits out of FTX. Sam's first Wall Street job was as a trader at Jane Street, only leaving the firm in 2017 to start the now defunct crypto exchange. But some of the mystery behind Jane Street's success is now known to be associated with their business in India. They entered the Indian markets in 2020, and in 2023, after years of researching and testing, their new strategy came to full maturity, and their revenues went parabolic. Yes, they've been growing globally too, but their business in India has become very meaningful. The burning question being, what did they find in India that was so damn profitable? Just a quick reminder to hit the subscribe button if you're enjoying the video and you want to see more of my videos appear on your homepage every now and then. Thanks to the investigation from India's regulators and the 100-page analysis they provided, we now know exactly what they found. It's actually pretty clever and a bit devious. Intraday index manipulation. That's a mouthful, but here's how it worked with a real example from the 17th of January 2024. On that day, the Nifty Bank Index opened down around 3%. This index is a basket of India's biggest banking stocks. One of India's biggest banks, HDFC, had reported disappointing financial results that was dragging the whole index down after the opening bell. So Jane Street steps in and starts aggressively buying shares in some of the bank Nifty stocks. We can actually see all of the trades here in the report. At 9:15, when the market opened, they bought HDFC, ICICI, SBIN, and a few other banking stocks. For most of these, they were accounting for 20 to 25% of all the buying. And this was all done within the first couple hours of trading. In total, they acquired roughly $500 million worth of these companies. And their buying was so aggressive that they essentially managed to prop up the price of the index by brute force. They were acting like the world's most generous buyer, holding up the market when everyone else wanted to sell. Now, why on earth would they want to do that? Well, options prices, specifically the price of put option contracts on the Bank Nifty index. A put option is essentially a bet that a stock or index will go down over a certain period. You can even buy put options to bet on the index falling later that same day, and the price to place such a bet is influenced by the price movements of the actual index. If the Bank Nifty was falling at the open, the price to bet on it declining further normally goes up, because a continuing decline throughout the day now seems more likely. But Jane Street's massive stock purchases caused the index to rise in the morning, or at least to stabilize it, which in turn made buying put options cheaper than they otherwise would have been. Again, SEBI's report lays all of this out. This is one of the put option contracts from that morning. It has a strike price of 46,800, which was a little above the price where the index started that day. It had an expiry on that same day, and the price was 229. So this is effectively a bet that the index will continue to fall throughout the day, and it costs 229 rupee. But within just a few minutes, the cost of that option bet goes down a lot. 123, 104, 82, and eventually to just 65 by 920. It's getting cheaper because with all of Jane Street's aggressive buying, suddenly a market decline doesn't look as likely. And they took full advantage of this, buying a ton of these put option bets. Their bet that the index would decline in the afternoon was more than 7 times larger than the money that actually spent on banking stocks. Which brings us to phase 2. After spending the morning supporting those bank stocks and quietly stockpiling cheap put options, Jane Street flips the script, suddenly dumping all of the banking stocks they had bought, essentially pulling the rug out from under the market. The stock prices of those banks resume their decline, and in turn, the Bank Nifty index also falls. Jane Street lost money on this aggressive trading. They were buying high in the morning and selling lower in the afternoon. But that was all part of the plan, because guess what happened to the put options that they were holding? As the index fell in price, they skyrocketed in value. That bet we were looking at before that got as cheap as 65 rupees at 920, when the market closed that day, they were worth over 700. The same was true for all of the other ones. Started the day at 500, was pushed down to 180, and then finished the day worth more than 1,000. The profits from the put option bets massively outweighed the losses that they experienced from dumping their stock position. SEBI estimates that Jane Street made about $85 million that day from using this trading strategy. A strategy that's only possible because India's options market is so much bigger than the actual stock market. When they'd buy and sell stocks aggressively, it would manipulate the prices. But since there was so much liquidity in the options market, they could acquire a huge bet without affecting the contract prices. Just a quick side story, this chart showing how insane India's options market is was posted on Reddit back in 2023, and one guy actually predicted that a firm might use this exact strategy to profit. If you can move the leverage needle in a 422 times market by moving money around in a 1 times unleveraged market, then in a corrupt country like ours, you bet fraudsters are going to manipulate the cash delivery market to find 10x or more money in the derivatives market. I won't go into too much more detail, but Jane Street also used other strategies like extended marking the close, where they'd trade heavily right before the market's close to influence the closing price of a stock. But all in all, it was ridiculously profitable, to the tune of $4.3 billion in profit between January 2023 and March 2025. An actual infinite money glitch. Until it suddenly wasn't. There's a fair bit of debate at the moment around whether what Jane Street did actually constitutes market manipulation, but India's regulators certainly thought so. Quote, dealing in multiple segments across cash equity, stock futures, index and index options simultaneously is certainly not by itself a breach of any regulation. The problem in the eyes of regulators was the intensity, scale, and intent behind the trades. The intensity and sheer scale of their intervention in the underlying stock and futures markets, the rapid reversal of these large and aggressive trades in cash and futures without any plausible economic rationale. In plain English, it's of course okay to trade stocks and trade options at the same time, but each of those trades individually on their own needs to make sense. Jane Street's trades in the stocks didn't make any independent sense. Buying a huge amount of shares in the morning and then dumping them a few hours later for a big loss is not a normal profit-seeking strategy unless you're doing it to manipulate something else. SEBI's final estimate of the profits generated illegally was about $570 million, all of which Jane Street was ordered to forfeit. And there's always an irony to these stories. The way that regulators even caught wind of this trade is a hilarious self-inflicted wound. A pointless lawsuit that Jane Street initiated itself. In April 2024, they filed a claim against 2 of their former traders, alleging that they had taken this brilliant India strategy to a rival firm, Millennium Management. In the heavily redacted court filing, they claimed that the trading strategy had generated $1 billion in profit in 2023 alone. Bloomberg published a story about the lawsuit titled "Ex-Jane Street Trader Pillories Claim He Stole Trade Secrets." And that exact article is cited in the SEBI report as the catalyst of the investigation. So they basically leaked their own strategy over a pointless lawsuit. Also, if anyone has information about the potential consequences of India's enormous derivatives market, feel free to leave a comment or send me an email. I feel like there's a deeper story there, another rabbit hole for me to go down. Subscribe if you enjoyed, and consider checking out this playlist of my best videos.